Now, the better-than-expected U.S. private sector jobs numbers, ADP numbers, also boosted sentiment in commodities overnight. Take a look at the Reuters CRB Jeffries Index, inching closer to a 27-month high, driven by gains in base metals, agri-commodities, and also precious metals. Let's get to Mickey Fulp, geologist and mining analyst at, I love this name, the Mercenary Geologist. He joins us now live from Albuquerque in New Mexico. Mickey, great to see you. Belated Happy New Year. Talk to us. I understand that you think a lot of the big run-up we've seen in commo prices has been driven by spec money, hedge funds and other hot money looking for a quick return, and that means that we could be in for a hard fall. Is that right?
Well, I think so, Martin, because when prices get this high, it makes me nervous, especially when everybody seems to get on board with more and more bullish prices. Copper is at an all-time high of $4.40 more or less right now, and it looks very overbought to me. The fast money, the hedge money, the speculation in this market has been tremendous over the last 6 months. We've seen nearly a 50% run up on the price, and I don't really think it's sustainable because the supply-demand fundamentals are just not very robust right now. Inventories are up for the 14th day in a row, and generally when that happens, prices go down.
Mickey, I'm sure you've been watching what's been happening in Australia with the flooding in Queensland. Is it a fair assessment to say that if we continue to see coal supplies and exports being squeezed, then the global price of steel stands to rise?
Well, most definitely. You know, metallurgical coal prices have been high for quite some time, and supplies have been quite tight. And when these supplies are interrupted, it's going to affect steel output. So definitely I think we're looking at steel output and steel prices, steel output going down and steel prices going up, and at least in the short term till the mines come back on stream in northern Queensland.
Yeah, Mickey, very quickly, I understand that you're most bullish for this year, for 2011, on uranium. Help me figure this out. We've been talking about this the last couple of days. China, apparently scientists there have come up with a way to reprocess nuclear fuel so they can use what uranium they've got for the next, I think, to power the generators for the next 3,000 years or something like that. They are not the first or only people with this technology. So does this mean absolutely nothing to the uranium market, or is it going to cap prices?
Well, I don't think it has anything to do with the short to medium term market, because this is a very complicated and expensive process. As you are aware, Martin, it's a process that has been developed for some time and is in great use in France and the UK and to a lesser extent in the United States. But we just are not finding, developing, and mining enough uranium for the last 10 years, and I don't see that we're going to be able to keep up with demand. There's 59 nuclear power plants under construction right now, and we have a deficit in supply. So I am very bullish on uranium for 2011 and even into the mid and long term.
Okay, Mickey, a lot of the gold bulls tell me that the world supply of gold is starting to peak, that mining production is peaking. You're a geologist. Is that the case?
Well, certainly mine production has gone down for most of this decade, but we had very low prices in the, say, the late 90s and the early 2000s. And so what happens is exploration goes away and we don't find new mines. I am not a subscriber to the idea of peak gold, just as I am not a subscriber to peak oil. I am very much a technologist, and I'm very bullish on our ability to continue to mine lower and lower grade deposits. So I think what you're seeing now is gold production is going to catch up.
All right. Listen, Mickey, got to go. Great to talk to you, sir. Mickey Fulp from the Mercenary Geologist, live over in Albuquerque, New Mexico.